Imagine waking up one morning, looking out the window, and realizing your entire town, or worse, your life savings, has just been wiped completely off the map overnight. Welcome to this explainer. Today we're uncovering something absolutely crucial, the hidden architecture of financial defense. Now, this isn't just some dry, abstract theory sitting in a spreadsheet somewhere. No, this is the literal mathematical science of global survival. It's the invisible armor that protects our entire economy from total collapse when the unthinkable actually happens. Okay, let's dive right into this. To understand why this matters, we have to look at reality. Back in 1993, the Great Flood literally entirely submerged the town of Kaskaskia, Illinois. Just gone. Fast forward to 2008, and we saw cascading financial risks that nearly submerged the entire global economy. The devastation in both of these cases was just visceral. Because, when extreme tail risks actually strike reality, they do not care about our carefully laid plans. Financial risk management exists for this exact reason. Catastrophic storms, whether they're literal weather events or massive economic crashes, are very real, and we have to build levees to survive them.
And that brings us to one number that literally keeps actuaries and bankers wide awake at night, the number 100. See, both of these professions are absolutely obsessed with what they call the 100-year event. To survive these things, they use something called extreme value theory to mathematically model these incredibly rare, catastrophic disasters. We're talking about the 99% worst-case loss scenarios. So when these professionals are building risk models, they aren't just, preparing for a rainy day. They're deliberately engineering massive fortresses designed to withstand a once-in-a-century economic hurricane.
So here's our roadmap for today's explainer. First, we'll cover the basics of risk management. Second, banking and Wall Street defenses. Third, corporate strategy and hedging. And finally, insurers and investment portfolios.
Part 1, Basics of Risk Management, the Science of Survival.
I used to assume financial risk management was just one of those vague business buzzwords, but it actually has a very formal definition. It's the practice of protecting economic value in a firm by identifying, measuring, and mitigating exposure to financial risks. Basically, it's about not sinking the ship when the water gets rough. What's really fascinating is that this discipline has a specific birth date as a modern science. It all started back in 1952 with modern portfolio theory, thanks to Professor Harry Markowitz. From there, it just evolved into this highly quantitative practice that focuses heavily on when and exactly how to hedge costly exposures. So, what exactly are they protecting against? Well, businesses broadly face 4 core risks. First, market risk. Think sudden changes in interest rates or commodity prices. Second, credit risk, the danger that someone just won't pay you back. It's a lot like lending a friend $20 and knowing you're never going to see it again. Third, operational risk, which is internal failures or system breakdowns. And finally, liquidity risk, which is simply not having the actual cash on hand to pay your bills. In all of these cases, a firm's capital acts as the ultimate buffer. It's the final line of defense that ensures a firm survives as a going concern, even if they take a really massive, unexpected hit.
Moving on to Part 2, Banking and Wall Street Defenses, Fortifying the Balance Sheet.
It is so fascinating to see how different financial institutions view risk in completely opposite ways. Take investment banks and fund managers. They intentionally take on market and credit risks. They actually want that risk because, that's exactly how they earn their returns, through trading and deal-making. But then you look at commercial and retail banks. They profit from the spread between deposit rates and loan rates. For them, their biggest nightmares are borrowers defaulting on loans or suddenly not having enough liquid assets when a bunch of customers want to withdraw their money. It's a night and day difference. Different business models mean completely different risk priorities.
Which leads us to a practice that is highly profitable but inherently risky. It's called maturity transformation. Here's how it works. Step 1. A bank takes your short-term deposits. Step 2. They use that money to fund long-term assets, like a 30-year mortgage. Step 3. They now have to meticulously manage the resulting structural mismatch. They are essentially borrowing short and lending long. It makes money for sure, but it creates massive liquidity and interest rate risks that require incredibly strict management of their assets and liabilities.
To keep all these wild risks in check, we rely on global regulations called the Basel Accords to act as a kind of physical armor for the financial system. And this armor is built on 2 main pillars. Pillar I mandates the absolute minimum regulatory capital a bank has to hold for highly quantifiable credit, market, and operational risks. Think of this as the legal floor. But then there's Pillar 2, which forces banks to conduct their own internal assessments to hold economic capital for all material risks. Regulators literally force these banks to mathematically prove, without a doubt, that they have enough armor to survive a worst-case scenario.
Part 3. Corporate Strategy and Hedging. Defending Strategic Objectives.
Now, stepping away from the banks, there's actually a massive debate in the corporate world captured by something called the hedging irrelevance proposition. The question is, should a company's managers spend actual money to hedge a risk, like a currency fluctuation, if their widely diversified shareholders could just do it themselves in the open market? Well, strict neoclassical theory says no, it doesn't add any value in a perfect market. But let's be real, we all know markets aren't perfect. So, in reality, corporate managers absolutely do actively hedge risks that threaten their company's specific, unique strategic objectives.
To visualize this defense, corporate risk managers use something called scenario-based contribution analytics. They look at base revenue, stressed revenue, and optimistic revenue, all against constant fixed costs. They really want to understand their break-even dynamics and safety margins. Think about a manufacturing company, right? Their main goal is producing and selling goods. Market risks, like a sudden spike in the cost of steel, are just an annoying byproduct. So they use these analytics to hedge away those distractions, allowing them to focus entirely on their actual business.
Finally, Part 4, Insurers and Investment Portfolios, Modeling the Unpredictable.
So, as it turns out, not all insurance is created equal. Life insurers, for instance, issue policies that span decades. Their risk models are entirely focused on long-term demographic shifts, longevity, and long-term interest rates. They meticulously match their investments to these really long-duration liabilities. But short-term insurers, like your property or casualty insurance, they face massive, sudden volatility. They rely heavily on highly sophisticated catastrophe models to prepare for things like hurricanes or earthquakes, which means they need huge reserves on hand for rapid claim settlements. It's a completely different philosophy of survival.
And when it comes to investing all those insurance premiums, managers use modern portfolio theory to construct diversified asset allocations. The holy grail here is finding what they call the efficient frontier, that exact sweet spot where returns are maximized for a very specific level of risk. Because asset returns aren't perfectly correlated, combining things like equities, corporate bonds, and treasuries can mathematically smooth out the ride. It's like putting shock absorbers on the portfolio to protect it from targeted hits.
Now, it's important to note that these sophisticated mathematical models didn't just appear out of thin air. The industry had to evolve the hard way. Back in the 1990s, quantitative finance relied heavily on something called traditional value at risk, or VAR. But then, 2008 happened. The financial crisis violently exposed the holes in those older models, and historical relationships just broke down entirely. Because of that devastation, the 2020s are now defined by much more sophisticated tools like extreme value theory and conditional VAR. These are designed specifically to capture those severe, catastrophic tail risks that the older models completely missed.
But all of this leaves us with a massive and frankly provocative question to end on. As incredibly sophisticated as extreme value theory is, can mathematical models truly predict the next global ransomware cyber attack, or a sudden geopolitical shock, or a systemic ESG failure? Today's financial risk managers are standing at a new frontier of qualitative, intangible risks that are incredibly challenging to quantify. We've built these incredible mathematical fortresses to defend the global economy, but it really makes you wonder, what are the absolute limits of quantitative finance in a world that is becoming more unpredictable by the day? Thank you so much for joining me on this explainer. I really hope it gave you a whole new perspective on the invisible architecture keeping our world afloat.